Okay, this is the second video for this week talking about nonprofits that make money. Remember, it is possible for nonprofits and a legal sense to make profits, but that money has to stay within the organization. However, there are certain activities that do in fact generate income that are not part of the purpose of the nonprofit, and that's called unrelated business income tax. So this is business income that is generated other than through the normal purposes of the nonprofit. For example, a church gives an annual fundraising banquet. Feeding people at banquets is not the primary purpose of the church. Is that taxable income? We'll see that it is not for various reasons. Girl Scouts selling cookies, or a charity running a thrift shop. These are all business activities that are basically unrelated to the business itself. For income to be taxed as UBIT, it must pass a three-pronged test. The activity generating the income must be a trade or business, must be regularly carried on, not regular in the sense of once every year at Thanksgiving or Christmas, but it would be better to say that is frequently carried on. And three, not substantially related to the purpose of the entity. So merely using the proceeds to pay the cost of the organization does not mean that that activity is substantially related. We'll talk more about that in a couple of minutes. Remember, all income that comes into a nonprofit must be used for the purposes of the nonprofit. So there must be some other aspect to look at for substantially related rather than what the money is being used for. And also, all three elements must be present to constitute UBIT. If there's only two out of the three, then it is not UIBT and it is not taxed. So what is a trade or business? Well, this is what all of us know. It's a operation that provides products or services. It's a business activity, and the purpose is to make money. And so you look at a thrift store, you look at sales of cookies, things like that. That is clearly a trade or business. Regularly carried on, the activity's frequency and continuity are compared with similar for-profit activities. This does not mean regular in the sense that it is regular every year. You have an annual banquet every year at a certain time. Rather, it's more characterization is frequently. Done for 1 or 2 weeks is not regularly carried on, but once a week throughout the year is considered regular. It's a factual question that is looked at by each case as the issue comes up. If it is not regularly carried on, it is not UBIT. So a banquet that's done once a year is not a regularly carried on activity, therefore it is not UBIT. Then the third step is not substantially related to the purpose of the entity. Again, the mere use of the profits for the purpose does not make it substantially related. It identifies the activity to the purpose of the organization, not the use of funds. The IRS looks at the purpose of the organization. Does this activity meet the purpose of the organization? Does the activity further the purpose, not just furthers money for the organization? So a church holding a car wash to raise money to send kids to a summer camp is not the primary purpose of the organization. Sending kids to the summer camp fits within the purpose of the organization. However, washing cars is not the purpose of the church. Charging tuition for classes does meet the purpose of the educational institution. So you look at the activity and match it with the purpose of the nonprofit organization. Let's look at something like the sales of a museum bookstore. Museums are 501c3 operations. They're educational. And so if they are selling books related to the museum, then the sale of those books is exempt because it furthers the museum's purpose of education. However, if at the same time they're selling maps, books unrelated to the museum, biographies, tchotchkes, things like that that are not directly related but raise money for the museum, then the sale of those items must be included as UBIT. So how can a store differentiate between exempt and UBIT taxed items? In today's world, it's fairly simple. The cash registers are programmed that the certain inventory items that are sold related to the purpose of the museum are listed as non-taxable items. Other items that are used are sold for the purpose of raising money for the museum, but are not in alignment with the purpose, would be characterized as taxable sales. So how can you plan for this activity and make sure that it does not become UBIT? Well, when you form your nonprofit, you fill out a Form 1023. And on that form, activities listed there should be related activities. So if you list the activity, then the IRS will have a hard time claiming later that those activities are not part of the business and are unrelated. The IRS would have to object to those activities when you applied for the tax-free status. So by planning ahead, you can anticipate certain activities, put them within your Form 1023, and the IRS would have a hard time objecting to them later. However, there are certain exemptions to the UBIT tax, certain things that would otherwise meet the three-pronged test, but there are exemptions that mean that it is still not taxed as UBIT. If the work is performed by volunteers, for example, volunteers preparing a Thanksgiving dinner, or volunteers selling cookies, this takes it outside the ambit of the UBIT tax. If the goods to be sold are donated to the organization, for example, a thrift store, many charities, churches, even some educational institutions may run thrift shops, may have sales of items that have been donated to that organization for sale. If the goods are donated, then it takes it outside the UBIT characterization. What about goods that are purchased by a thrift store from the Salvation Army? The Salvation Army is a qualified nonprofit corporation, and the goods that they got would mean that the sale of it would be nonprofit to the Salvation Army. But are those goods that have been donated to the Salvation Army, does that characterization carry over if those goods are purchased by another nonprofit thrift store? No. They purchase those goods, then that takes it out of the exclusion, and the sale of those items would be included in UBIT. Another exemption from the UBIT is bingo. Bingo is specifically exempted. It cannot be done on a commercial basis, and it's generally done on the premises with cards. So the activity would clearly be UBIT if the bingo game, except for this specific exemption. Activities primarily for the benefit of the staff or customers of the nonprofit organization. For example, the in-house dining facilities in a hospital. The hospitals work 24 hours a day. The nurses, the doctors, the people that work there need a place to eat. And even though it may be a profit-making operation, it's there primarily for the purpose of meeting the needs of that nonprofit organization. So it would not be included in UBIT. Likewise, parking for staff and customers. If it's paid parking, that would not be included in UBIT because it's provided for the benefit of the staff, which are meeting the primary purposes of that organization. Rental income and investment income. If a nonprofit has excess office space, it may rent that space to third parties unaffiliated, and that income is not UBIT. This is called passive income, income from investments in stocks, bonds, interest, things like that are not included as part of a nonprofit UBIT. So we have the three-pronged test determining whether or not income is unrelated. We have certain exemptions that take it out of that unrelated, but then a nonprofit may still be generating unrelated business income. If that unrelated business income becomes substantial, then it may threaten the nonprofit status of that nonprofit. So unrelated business becomes the primary purpose. The IRS may revoke the tax status of that organization. If that happens, donors can no longer deduct their donations. We'll be talking about that again a little bit later, but it's a very serious consequence. So you have to be careful that the UBIT does not become so substantial that it overpowers the purpose of the nonprofit. One way that that can be dealt with is to create a feeder organization. This is an organization that's owned by the nonprofit and carries on the nonprofit business on an after-tax basis. Feeder organizations are created by nonprofit companies. They are tax companies. They are Regulation C, fully taxable organizations. They pay the tax on their income. The net income then becomes a donation to the nonprofit. They are separate organizations, fully taxed. And all that income will then go to the nonprofit, and it is not UBIT to the nonprofit because it has already been taxed. True Bethel Church in New Jersey is an example of this. It actually formed a subway, formed a corporation, and the income from that subway then became donations to the church. So the income of the subway was not UBIT because it was with a separate taxable corporation. How do you pay the UBIT tax if you have this as a nonprofit? You only pay the tax on the UBIT income, not on the total income, only that from unrelated business. And you can deduct ordinary expenses that are related directly to the generation of that UBIT. It's treated as if it is a for-profit segment within the nonprofit company. And then you pay the tax on the amount of the UBIT. So, taking advantage of being a tax-exempt entity, a nonprofit can fulfill its mission. That money that would have gone to pay taxes is now used for the purpose of the nonprofit. So that is one of the great benefits of not having to pay taxes as a nonprofit organization. Most nonprofit organizations need donations to survive. Being a 501c3 gives that organization the credibility that the government also agrees that their purpose is a non-taxable purpose for charity, education, religion, etc. To attract donations, a nonprofit needs the validity of the government. Also, it's essential that the organization obtain a tax-free status and maintain it. And the donors get the benefit of being able to write off the donations from their income as well, a key factor for nonprofits. And remember that it is possible for nonprofits to create some taxable income so long as it is not excessive, and it is then taxed on that unrelated business income tax, but it is not taxed on the entire income of the organization. Okay, so that deals with the taxation of nonprofits, and the next section we will go into marketing of your nonprofit.